week 2 of Money in Banking, and you're doing a great job so far. Very happy with that. This week's keyword will be February. This week's keyword will be February. I hope you had a happy Valentine's Day. We're just kind of warming up here after a while here in the Northeast, which I know the whole country has kind of suffered from that. So yeah, we're ready to roll. So let's not waste any time. Let's go right into our class. So I'm going to share my screen. Okay. We are. And now let's take a look at week 2. So for week 2, we're going to analyze the financial market. So let's go right to our assignment. And you've recently joined an investment advisory firm as a junior analyst. One of your first responsibilities is to assist a financial advisor, Emma, who is working with a client approaching retirement. The client is interested in building a portfolio that includes both bonds and stocks, but wants to minimize risk while maintaining reasonable returns. To support Emma, you'll create a concise report explaining how bonds and stock markets function, how investments are priced, and how broader economic conditions affect these markets. Your report will help to inform the client's investment decisions and demonstrate your understanding of key components of the financial system. Remember, the key word is February. Create a short report, 500 to 600 words, on bond market basics. Describe the main participants, the issuers, investors, and intermediaries. Briefly compare types of bonds, government, corporate, and municipal. Remember, municipal bonds are tax exempt on this for federal taxes. Government bonds are tax exempt on state and city taxes. It's a reciprocity clause in the Constitution, or at least they at least feel Constitution supports that. I guess separation of federal and state. But bottom line is, when you buy a municipal bond, you don't pay federal taxes on it. When you buy municipal bonds, you don't pay federal. And when you buy government bonds, you pay state or city. Sometimes municipals can elect to make it federally exempt. I'm not sure how they do that, but they do that, and you get triple tax exempt bonds. In which case, it has an advantage. But then again, investors will pay higher prices, especially if they're in a high tax bracket for those bonds. So it sort of balances it out. And then, of course, you have the corporate taxes. Summarize how the stock market works. And I just explained this to somebody, that the stock market, people tend to think when the stocks trade, the money goes right to the company. The money only goes to the company when there's an initial public offering. So like for instance, Apple, when they first started selling shares to the public, that's the day they get the money. Of course, they own shares too, and that's a big part of their wealth. The owners who started their own shares, the officers, the directors. But as the stock trades, it's just like eBay. It's like you already bought the thing, and now people just trade with one another. Now, it's important, the stock market, because it tells you the value of your company. It tells you liquidity. It kind of signals the worth of your company. But at the end of the day, that's what it is. Okay. And finally, we want to talk about the macroeconomic factors, which is a big part of this. What's going on in the economy. So if we go back to our content, you'll see that. Go back to our announcements. You'll see that on the week 2 guidance that I did give you, you can kind of go through this. So understanding bonds markets, you could use this guidance to write this memo. Okay, as investors approach retirement, building a balanced portfolio that includes both bonds and stocks is an effective way to manage risks while still achieving long-term financial goals. Bonds provide income stability because you're getting that steady payout, while stocks offer potential for growth. To support sound decision-making, it's important to understand how these markets functions, how investments are priced, and how economic conditions influence performance. The bond market consists of several key participants, including issuers, investors, and intermediaries. Issuers include governments, municipalities, and corporations that sell bonds to raise capital. Okay? There were three primary categories. Government bonds, like U.S. Treasuries, are considered the safest because they're backed by the federal government, which is considered the safest investment in the world. Corporate bonds are issued by companies and typically are going to give you a bit of a higher yield than governments because, the odds of even Apple or Coca-Cola going bankrupt is greater than the government going bankrupt, right? Although those are two horrible scenarios. Municipal bonds issued by state and local governments often provide tax advantage, which I went over. A key principle in bond investing is the inverse relationship between interest rates and bond prices, which essentially means when interest rates go up, think about time value of money, bond prices go down. Now, why is that? Well, let's say you've owned a bond. You could trade bonds in the market. You can value bonds in the market. You can also trade them in the market. So let's say you own a bond that paid a 5% interest rate. And all of a sudden, every bond like your bond is now paying 7%. In order for you to sell that bond, you're going to have to take less of a price for the bond because the buyer wants to be compensated for the higher interest rate, right? You're getting 5, everyone's getting 7. So by paying a lower price, and that's all calculated by time value of money, the buyer gets, say you pay 900 for it instead of 1,000. They'll get the 5% coupon, but at the end, say in 5 years, say it's a 5-year bond, they'll get that extra $100. That extra $100 that they get in the last year, that will represent the extra 2% that makes that even. Okay, so that's why, in the same way, if you want a bond that pays 5% and everyone else is only getting 3 because they lowered rates, you're going to get more for your money because you want to be compensated. So at that point, you might sell your bond for $1,100, and that extra $100 compensates you for the money you're giving up. But try to think of it that way. It's an inverse relationship. Once again, when interest rates go up, bond prices go down. And when interest rates go down, bond prices go up. So the stock market enables companies to have funds by issuing shares. There are two types, and we talked about this. Common stock, which is what you see all the time, which is we're basically taking a company and you're breaking it up into shares. And by breaking it up into shares, so say, for instance, I have a company that's worth $100 million, and someone else has the same company that's worth $100 million. I could break mine up into 100 shares, which means each share would theoretically be worth 1 million. If you broke up your company by 1,000 shares, theoretically your company would be worth $100,000 a share. Both companies are the same. It's just how I broke up the company, and that's what a share of the company is. Okay. And in most cases, there's a lot more float. There's a lot more shares, so the stock goes down a lot. In other words, you look like at a Microsoft that has hundreds of millions of shares. Those shares are worth still a lot, $200-300 a share. But when you multiply it by the number of shares outstanding, you get the value of the company. Okay. And then, of course, you want to look at these macroeconomic influences like inflation and interest rates and watch what the Federal Reserve is doing. So to me, that's how you want to write this thing. But more to the point, you always want to look at the macroeconomic factors that are affecting the market. And the best place to see that is in places like the Wall Street Journal. They constantly follow it. So here you got live, tech stocks are gaining ground today. The Dow is rising, tech stocks are gaining. There was a worry that AI would be too costly for them, but obviously they are turning the corner. And they'll also tell you this is just by following this. Just by following this, you start to get the idea as to what stocks are worth and what the economy is basically signaling. So you see the markets are up today and they're pretty strong, up 1% across the board. And gold, which has been an indicator, is up nicely too today. Seems like gold in the stock market's acting pretty much. But look at Bitcoin. Bitcoin has really gotten hit over. So these are all economic indicators that you should be following. These are all economic indicators that you should be following. Okay. All right. Really important that you do that. And that's why I say to read those papers all the time, because as an investor, as somebody who is learning now about finance, there's no way you can get really good at this if you're not following the financial press. And the Wall Street Journal is a great place to start. It really is. Okay. And you can even watch videos if you like. All right. Good stuff, right? But you should read the articles, obviously. Let's just watch this one on Walmart. And the reason I want you to watch it on Walmart is because I feel that Walmart is a great company to follow. One of the great companies, Amazon might be one too. I feel that Walmart is a great company to follow. Okay, thank you. Because it also provides one with a great look on macroeconomic conditions. Just give me a minute. Excuse me. Stop sharing for me. You know what happens when you share? You miss the void. You miss the sound if you don't share it correctly. Oh boy, I got to tell you, from my standpoint, not easy working with teams. It really isn't. There's so many moving pieces. Oh God. Let's try this. Oh, I got it. Okay. Huh. Unbelievable. I'm sorry about the delay. It's just annoying. I don't want to share my screen without sharing the sound. That's my problem right now. Just bear with me for a minute. Okay, hold on one sec. Gotta tell you, one of the most difficult things in this whole universe is working with teams. I think Microsoft is great, but I have found that it's not the easiest thing to work with. Okay, now there's so many moving pieces, really so many. And then these bars drive me crazy. Okay, hold on. Oh, man. Good. Finally, let's watch this.
We could see breakthroughs in efficiency.
Hold on a minute. Boy. Give me a minute, please.
But more importantly, looking at new ways to serve customers, new ways to enter markets, or to create entirely new offerings. That's what's transformative. And so you have a capability that's never existed before that's enabling the break of traditional orthodoxies, traditional ways of thinking about performing work.
Two big decisions, two controversial decisions, two expensive decisions that you made early in your time that have really kind of defined that time. And you've already hinted at both of them. But the first was to raise associate pay, training, a big investment, $3 billion in lifting your associates. The markets hated it. You got pummeled in 2015.
Yep.
Well,
That was fun.
why did you do that in spite of that market sentiment?
Well, that plan that I mentioned was one that I really believed in, and others did as well. And when we talked to the board about it, we said, here's what we need to do. And the bad news is it's going to cost us a lot. We're going to have to take the earnings of the company down, reset the operating income percentage with these wage investments and price investments. And then we'll come back and talk to you about e-commerce. And to the board's credit, all of them, the Walton family members as well as the independent directors, said, we agree with that plan, but we want you to be even more aggressive. So
Wow.
instead of investing what you have proposed, take 2 weeks, we're gonna have a conference call, tell us what you would do if you were a lot more aggressive than what you
So you took
said.
it up?
We did, we went up even more, which led to the reaction in 2015 by the investment community.
I mean, my sense of the Walmart strategy and of the Walton approach, and through reading books and others, was you would pay the lowest price you could possibly pay for every input, and labor was included. It seems like what you did then was a pretty big change.
And let me tell you something, this is an important macroeconomic indicator. Walmart is such a huge company. It's the largest supermarket company in the world, right? We all know about it. It's all over the world. It's all over the country. Let's say the country, right? So their their ability to view our ability to view Walmart as a macroeconomic indicator is paramount. Because if more Walmart, it's not that at this point, Walmart is so big and has done such a good job that it's not whether they're going to sell things. People are going to buy things from Walmart. People, that's a big part. It's like Costco has done very well, obviously, Amazon, but Walmart is the granddaddy of retail, right? Well, we know people are going to shop there. And even more important, it's a broad indicator because Walmarts are everywhere. As opposed to some companies that might just be in the cities, Walmart is all over the place. Therefore, something we want to follow for macroeconomic indicator. So that's why I'm trying to kind of get you not just to do this assignment to Emma, but also to start thinking about how to prepare these things. So long story short, Walmart, no question, is one of those companies that gives you a great indicator on macroeconomic conditions. Great, good to know. More to the point, they're also raising salaries. So now, as a macroeconomic indicator, not only are they selling things, but they're also a great indicator of how labor now is getting higher prices. Because if Walmart's paying more, and they are paying more, then it's a good indicator for the economy and where the economy is heading, even in terms of employment. So the other thing is, we know people are going to buy things from Walmart. And so it's just a function of, do people have the incomes to buy things now? And so if they do have the income and Walmart is selling stuff, well, then on the other hand, we could assume that the economy is doing better and there's actual evidence. So let's finish watching this.
I think if you go back, that actually wasn't the way we were approaching it. We basically played at market for the hourly wage and then plussed it up with a bonus, with access to a stock equity plan, profit sharing back in the day. So as it relates to associate wages, it was never in our plan to pay the lowest amount we could. We've paid more than that minimum wage, for example, forever. But what had happened in the years leading up to it is we just drifted south. When we had pressure, we didn't keep up like we should have. So that was the big adjustment that needed to
How
happen.
important to you, how important was that in the success?
Yeah, huge. Because our people do make the difference. This is an associate-driven company, and it was a sign of respect. Not only the wage increase, but everything else they asked us to do. We just went and did that, and we told them that's what we were doing. And they're the ones that make things happen. So not only quantitatively, but emotionally, it meant a lot because they said they heard us.
And I want to talk about technology, but it's interesting you put that before the technology move.
Yeah. You couldn't do the technology stuff if you didn't get the
have
people to the right place. You're not going to have happy customers if you don't have happy associates.
We could see breakthroughs in efficiency, but more importantly, looking at new ways to serve customers, new ways to enter markets, or to create entirely new offerings. That's what's transformative. And so you have a capability that's never existed before that's enabling the break of traditional orthodoxies, traditional ways of thinking about performing work.
Okay, so that's just a
If you can, go back to what was in your.
Okay, so you get a good idea. I think it's a great way to give you an introduction to macroeconomic factors. All right, so the key words this week are, let me stop sharing for a minute. The words this week will be February. And what I really want you to do, and let's do one other thing. Let's look at one other thing. I'm going to share my screen again. We'll go back to our class, which is a great class. And when you finish that, let's take a look at your discussion. So the discussion basically this week revolves around you looking at derivatives, right? And I added some guidance here. I believe I put it here. Let's see where it is. Here it is. When responding to discussion, focus on clarity and distinction. Start by clearly explaining the intent behind each approach. Hedging is about protecting your profits. The goal is to reduce or transfer risk that already exists. Speculating, on the other hand, is about seeking profits from price movements. So speculators try to make money, hedgers try to protect what they own. A good way to frame this is hedgers already face risk and want to manage it, while speculators voluntarily take that risk on. Someone has to. That's how economics works. If somebody wants to manage their risk, they have to find somebody who wants to take that risk. Next, explain how risk exposure differs. Hedging reduces uncertainty and stabilizes cash flow, though it may limit upside potential, right? The one thing when you hedge, you limit your upside, you almost limit you also limit your downside, and that's the idea behind hedging. Speculating increases exposure because the investor is betting on price direction. Be sure to emphasize that speculation can amplify both gains and losses. For your real world example, choose something concrete, like airline using fuel. I love that idea. You know, the airline knows what they're going to make during the holidays, right? They know that it's the holidays are coming and they're going to make X. They're going to fill so many seats. The only risk, the pilots are locked in, the gate people are locked in, the stewards are locked in, but the maintenance people are locked in, but oil is not locked in. And they can go into the oil markets and lock in the price of oil. Now, when it's time to fill the planes up, if the price of energy goes down, well, they've given up that profit, right? But if the price of energy goes up, they've reduced that risk. And in this case, they can deliver steady earnings to their shareholders. So you want to talk about stuff like that, but that's a good example, and you could use it if you want. So that's it for today. February is your keyword. Follow my guidance, and you guys have been doing great so far. Just keep doing what you're doing.